When I started trading, I believed my academic background would give me an advantage. I had degrees in engineering, metallurgy, and applied mathematics, yet the market quickly taught me that knowledge alone does not produce consistent profits. Trading is not an intellectual contest, it is a psychological one. My first trade was in 1982, and from that moment, I began to understand something many traders learn the hard way. The real edge is not intelligence, it is discipline. The market rewards the trader who can wait, follow rules, and act without emotional interference. Over the years, I realized that consistency comes from learning to think in probabilities. A trader cannot control outcomes, but he can control his process. My approach is mechanical because the human mind is easily disturbed by fear, excitement, and the urge to act. I focus on ticking a series of boxes before I take any trade. Most opportunities must be ignored. The professional trader waits patiently until everything aligns. When those moments arrive, what I call the real opportunities, I execute without hesitation because the plan has already made the decision. Many beginners believe charts, indicators, or moving averages create profits. In reality, price moves because businesses make money and because traders respond emotionally to information. The psychological challenge is learning not to react impulsively. I remind myself constantly that the market does not care about my opinion. My job is simply to follow my method with calm and discipline. When you develop the ability to wait, trust your rules, and detach from individual outcomes, your hit rate improves and trading becomes a structured professional activity rather than an emotional gamble. Subscribe to Live Trading Mindset and follow the real journey of becoming a disciplined trader. Here we document the psychology behind every trade, the mistakes, the lessons, and the process of building consistency in the markets. If you are serious about trading and working on your mindset, this channel is for you. When I began studying the market seriously, I realized something that changed the way I think about charts. The market does not move toward the average moves toward the market. Price leads everything. Many traders believe indicators control the market, but that is an illusion. My first rule is simple. I must understand whether the market itself is rising or falling. Everything I do as a trader comes from that single observation, because fighting the overall direction of the market is usually a losing psychological battle. I learned this lesson the hard way during large market declines. When a portfolio falls 10%, most people say they will give it a little more time. At 15%, they say the same thing. At 25%, they still hope it will recover. Then the market reaches the bottom and fear finally takes control. Many traders sell exactly at the worst possible moment. I have done it myself. That is the psychological trap of hope turning into panic. The professional mindset is different. Instead of reacting emotionally, I must read the market and respond objectively. There is another lesson hidden inside those big losses. If your account falls 40%, you need about 66% just to get back to break even. That reality destroys many traders because they lose not only financial capital, but also emotional capital. When traders experience deep losses, confidence disappears. I know many people who moved completely into cash after the crisis because the fear stayed with them. Their money sat idle for years, earning almost nothing, simply because their psychology could not recover from the shock of the loss. In trading, I often hear that about 95% of people lose money while only a small group becomes consistently profitable. My goal has always been to train my mind to operate like that small group. Most beginners never reach that level because they run out of capital or patience before their psychology matures. In Chicago, they used to joke that professionals like doctors, engineers, and lawyers lasted only a few months in leveraged markets. Intelligence is not the problem. The real challenge is emotional pressure and the ability to handle uncertainty. To survive in trading, I discovered that a trader needs a specific psychological toolkit. You need determination, courage, and the ability to stay calm when several trades fail in a row. Losing streaks are part of the business. If a trader cannot remain emotionally stable during those moments, the market will expose that weakness immediately. What keeps me consistent is not confidence in a single trade, but confidence in my process. When my process is solid, I can remain patient and execute the next opportunity without emotional hesitation. Many traders search endlessly for new strategies, new indicators, and new systems. I used to think the same way. Eventually, I realized that success usually comes from mastering one simple approach and executing it with discipline. Bruce Lee once said he feared not the man who practiced 10,000 kicks once, but the man who practiced one kick 10,000 times. Trading works exactly the same way. The edge comes from repetition, discipline, and psychological consistency, not from constantly chasing the next new method. When trading starts working well, something strange happens psychologically. The process becomes repetitive and even boring. I am simply executing the same setup again and again. Many traders struggle with that stage because the mind begins to search for stimulation. I have seen good traders lose money not because their strategy stopped working, but because they became restless. They start forcing trades, trying to pick market bottoms, or doing something aggressive just to feel the excitement of action. I have felt that temptation myself. Sometimes the urge to do something reckless appears, almost like the urge to scratch an itch. Some trading coaches even suggest allowing yourself one small aggressive trade occasionally just to release that pressure. But the real professional mindset is learning to recognize that impulse without letting it control your decisions. My focus must remain on execution, not entertainment. Trading is a business of discipline, and discipline often feels repetitive. For that reason, I prefer a swing trading approach rather than constant intraday activity. It gives me the ability to wait for clear opportunities and reduces the psychological noise that comes from watching every tick. But even with a good method, survival depends on money management. If I want to operate like the small group of successful traders, I must control risk on every single trade. That rule is non-negotiable. In my own trading, I typically risk about 1% to 1.5% of my capital on a trade. That percentage represents the distance between my entry price and my stop loss. If my account were £100,000, 1% would be £1,000. That means the worst possible loss on that trade must not exceed that amount. To achieve this, I adjust the number of shares I buy, so the risk always remains controlled. This concept is called position sizing, and psychologically, it is one of the most important skills a trader can develop. Most traders fail because they trade too large. A few losing trades arrive, pressure builds, and suddenly the account is damaged beyond repair. When risk is controlled, however, losses remain small and manageable. That allows me to stay calm and continue executing my plan instead of reacting emotionally to temporary setbacks. I often remind myself of a simple idea expressed by the trader George Lane. The objective of trading is not to win every trade. The objective is to make sure I still have enough capital to trade tomorrow. That mindset changes everything. Once I understand that survival is the first priority, my decisions become more rational and less emotional. When I analyze a stock, I want to answer three very simple questions. First, what is the true value of the company? Second, how safe and reliable are its earnings? And third, what direction is the price actually moving? The first two questions come from fundamental analysis, which is the search for the real value of a business. The third comes from technical analysis, which studies trends and turning points in price. Many years ago, my grandfather explained a principle that stayed with me throughout my trading career. He said the only reliable way to make money in anything is to understand the value of something and then buy it for less than that value. That idea may sound simple, but psychologically it teaches patience. Instead of chasing every movement in the market, I wait for moments when value and price create a genuine opportunity. I remember speaking at a small investment club in London one evening. After the talk, an elderly gentleman approached me. He had been running a second-hand watch shop near St. Paul's for decades, specializing in Rolex watches. He told me that his business followed a very simple rule. Whenever someone brought him a watch to sell, he already knew exactly what it was worth. His profit came from offering a price below that value. It sounded simple, but that is exactly how professionals think about value. The same principle appears in investing. If you read The Intelligent Investor by Benjamin Graham, who mentored Warren Buffett, most of the book is dedicated to understanding how to value an asset. Only at the end does he explain the final step. Once you know the value, you simply wait until the market behaves irrationally and offers the asset at a cheaper price. In trading terms, the key questions remain simple. What is the asset truly worth? How safe are its earnings? And is the market currently moving up, down, or sideways? In my process, I want clear answers to those questions every evening. The system I use calculates a valuation for every stock in the market. The model examines financial data such as the balance sheet, income statement, and cash flow information. It also incorporates earnings forecasts for the future. All of that information is processed to estimate what the share should be worth today. Once that value exists, I can quickly identify companies trading below their estimated worth. This approach reflects the same logic used by the watch dealer. If I know the estimated value of a stock, my goal is to buy it at a price that offers an advantage. But value alone is not enough. I also pay attention to what is called relative value, which measures how much a stock could potentially outperform a safer investment over time. In simple terms, it compares the potential growth of the stock with the return of a corporate bond over the next few years. When a stock shows strong relative value, it means the earnings outlook suggests significant upside compared with safer assets. In my experience, stocks with stronger relative value often attract attention from investors and momentum traders. That growing interest can drive price trends. Because of that, I prefer focusing on stocks where the potential reward clearly stands out compared with the alternatives available in the market. Another important measurement is the reliability of the company's earnings. I want businesses that demonstrate consistent and predictable financial performance. The market tends to reward stability, and stable earnings reduce uncertainty in my decision process. When I combine value, growth potential, and reliable earnings, I begin to see opportunities with a much stronger psychological foundation. Instead of guessing, I am working with structured information that supports disciplined decision-making. When I look at the safety of a company's earnings, I want that number above 1. The higher it is, the more consistent and predictable the business tends to be. Conservative investors often prefer extremely high safety levels because that reduces the chance of unpleasant surprises. In my more momentum-oriented trading, I am willing to accept slightly lower safety as long as it remains above 1. What matters to me is balancing opportunity with stability so I can participate in strong trends without exposing myself to unnecessary risk. So my focus becomes very clear. I look for shares that appear undervalued. I want strong relative value because that signals potential growth, and I want earnings stability above a certain threshold. But none of that matters if the market itself is not moving in the right direction. That is where trend analysis comes in. The timing measurement simply tells me whether the price is rising or falling. If the number is above 1, the stock is moving upward, and the higher it moves above that level, the stronger the trend becomes. What interested me most about this approach was seeing these ideas combined into a single measurement that reflects value, safety, and trend at the same time. For the first time, I could look at one number that blended both fundamental and technical thinking. Traditionally, those two camps rarely agree with each other. Fundamental analysts focus on company performance, while technical traders focus on price behavior. In many investment circles, they almost behave like two different tribes arguing about whose method is correct. I have always preferred a more pragmatic mindset. My objective is not to defend a theory, but to make consistent money in the market. When I combine the strengths of both perspectives, I gain a clearer picture of opportunity. Fundamentals help me identify businesses with strong financial potential, while technical trends show me when the market is actually rewarding those companies. When both align, the probability of success improves dramatically. Risk management still remains essential even when everything looks promising. Every position must have a stop level that defines the maximum acceptable loss. That stop is not random. It adapts to the characteristics of the stock and the strength of its fundamentals. When a company is fundamentally strong, I allow the price a little more room to fluctuate, so the normal movement of the market does not force me out of a good position too early. There is a famous idea expressed in the classic trading book Reminiscences of a Stock Operator. The author describes how successful traders understand that profits are not created by constant analysis. The real money comes from holding the right position once it begins moving in your favor. Many traders can identify a good trade, but far fewer have the patience to stay in it long enough for the move to develop. Learning to sit patiently in a winning trade is one of the most difficult psychological skills in trading. When a trade begins moving in my favor, the natural instinct is to grab the profit quickly. Many traders feel an urge to close the position the moment they see green on the screen. But the real opportunity often lies in allowing the trend to develop. My job is to identify a strong share that is moving upward and then have the discipline to stay in the trade while the momentum continues. To protect myself while doing that, every trade must have a stop loss. The stop serves two purposes. It protects my capital if the trade fails, and at the same time, it allows a good trade enough room to develop without forcing me out too early. That balance is essential. If the stop is too tight, I get shaken out of good positions. If it is too loose, I expose myself to unnecessary losses. Managing that balance helps me stay calm while the market moves. Another important part of the process is having clear signals that tell me when to buy, hold, or sell. Many traders spend years learning how to read charts, and I respect that skill. But the psychological challenge is often not analysis, it is decision-making. When signals are clear and objective, there is less room for emotional interpretation. Instead of guessing or debating with myself, I simply follow the signal and execute the plan. Individual stocks may look attractive, but the overall market direction has enormous influence on the outcome of any trade. Because of that, I always prefer buying rising shares when the overall market is also rising. That alignment dramatically improves the probability of success. Some traders also profit from selling declining stocks in falling markets, which is known as shorting. However, for most developing traders, the priority should be mastering the basic process first. Learning to buy strength and manage risk effectively already provides more than enough opportunity. To read the behavior of the market itself, I analyze a broad index that represents the collective movement of many shares. Instead of focusing only on large companies, I prefer looking at an equally weighted group of stocks. That approach gives a clearer picture of the overall sentiment in the market. Each evening, every share in the market receives a clear signal: buy, sell, or hold. From that information, I calculate what I call the breadth of the market. It is simply the number of shares on buy signals divided by the number on sell signals. That ratio gives me a powerful view of market participation. If many stocks are moving into buy signals, momentum is expanding. If sell signals begin to dominate, it tells me that weakness is spreading beneath the surface of the market. From this data, I monitor both a short-term and a long-term trend. When both trends point upward, the message becomes very simple. It means the market environment is supportive and the probabilities favor being invested. I always remind myself that trading becomes easier when I align with the direction of the broader market. When both time frames point upward, the strategy becomes straightforward: focus on strong shares and allow the trend to work in my favor. Today, this information is incredibly accessible. I can check the state of the market quickly from my phone in just a few moments. That means there is really no excuse for being unaware of the overall environment. I do not need to watch screens all day. What I need is a few minutes of focused attention each day to understand what the market is doing and whether conditions remain favorable for my strategy. When the long-term trend turns positive, the signal is clear that the market is supportive and that I should be participating. Historically, those moments are when strong trends develop and opportunities expand. But the opposite situation requires a completely different mindset. When the signal turns negative, my priority shifts immediately from opportunity to protection. I stop opening new positions and begin examining the risk within the trades I already hold. In those moments, I review my positions carefully. I check where my stop losses are placed and make sure my risk remains controlled. I also look closely at the stocks that have not performed well during the previous advance. If a stock failed to participate when the market was rising, it is unlikely to behave well when the market begins to weaken. Removing those weak positions protects both capital and emotional stability. Psychologically, this is an important shift. Instead of reacting with panic when markets become uncertain, I follow a structured plan. When conditions deteriorate, my job is simply to become more cautious. I reduce exposure, manage risk, and remain patient. The trader who can stay calm and disciplined during those transitions preserves both financial capital and the emotional capital needed to take advantage of the next opportunity. When the market signal turns negative, some traders consider shorting opportunities. Shorting simply means selling something you do not own with the expectation that the price will fall. It can also be done through instruments like inverse ETFs that move opposite to the market. But for most traders, especially those still developing their consistency, the appearance of a negative signal should primarily mean one thing: caution. It is a moment to protect capital rather than aggressively search for opportunity. Markets often experience temporary pullbacks, especially during quieter periods of the year. A sell signal may appear briefly and then disappear as the trend resumes. That is normal behavior within a broader uptrend. What matters is not predicting how far the market will go, because no trader truly knows that. My focus remains on reading the current conditions. If the trend is upward and participation across stocks is strong, then the environment supports being invested. In those moments, I remind myself of a simple idea from sport. When the ball is in play, the game continues. The same mindset applies to trading. If the trend remains upward and my positions are behaving well, then I stay involved. I do not try to predict when the move will end. Instead, I allow the market to show me when conditions change. That approach removes a huge amount of psychological pressure from the decision process. The most important mental discipline is staying present. As a trader, my job is to evaluate what is happening now, not what happened yesterday, and not what might happen tomorrow. When the mind drifts into the past, it becomes trapped in regret. When it drifts into the future, it begins imagining problems that do not yet exist. Both distractions weaken decision-making. My attention must remain on the current price bar and how it relates to my trading rules. I sometimes joke about this by saying that traders suffer from two types of mental mistakes. One comes from past errors that we keep replaying in our minds. The other comes from imagined future mistakes that we fear might happen. Both remove our focus from the present moment where decisions actually occur. When I follow my rules and concentrate on executing this one trade correctly, I eliminate most of that mental noise. That mindset is similar to how any skilled professional works. A surgeon does not worry about the previous operation or the next one while performing a procedure. He concentrates fully on the task in front of him. Trading requires the same focus. My responsibility is not to control the market. My responsibility is simply to execute my method with precision and discipline on the opportunity that exists right now. I do not need dozens of complicated strategies. I focus on that single structure and repeat it whenever the conditions appear. When everything lines up, I act. If it does not, I simply wait. In reality, the challenge is rarely finding the opportunity. The real challenge is having the patience and emotional control to stay with the trade once it begins working. Many traders buy a stock at 10 and sell it the moment it reaches 10.20 or 10.50, just to confirm that they were right. That behavior feels satisfying for the ego, but it destroys the real potential of the trade. The professional mindset is learning to allow the position to grow. Many traders buy a stock at 10 and sell it the moment it reaches 10.20 or 10.50, just to confirm that they were right. That behavior feels satisfying for the ego, but it destroys the real potential of the trade. The professional mindset is learning to allow the position to grow. What separates successful traders from the rest is the ability to do something that feels psychologically uncomfortable. Instead of constantly closing trades, they sit patiently in winning positions. Even more difficult, sometimes they add to those winning trades as the trend strengthens. That idea feels counterintuitive to many people because emotionally we are trained to take profits quickly. Yet the real growth of capital often comes from allowing strong trends to continue. Adding to a winning position requires confidence in the process and strict control of risk. It is not reckless behavior. The position grows gradually as the market confirms the strength of the trend. When done correctly, this allows a trader to build meaningful exposure to the best opportunities while still controlling downside risk through disciplined stops. The key is that every decision remains aligned with the original method. I often compare this mindset to situations where momentum builds in other environments. When conditions align and momentum begins to accelerate, the opportunity expands. But the trader must have the discipline to recognize that moment and participate in it rather than stepping away too early. Most people hesitate at exactly the moment when confidence and patience are required the most. That is why I return again and again to the same simple structure: an undervalued stock, strong earnings growth, and a clear upward movement confirmed by the market. When those pieces appear together, I know I have a situation worth acting on. My responsibility is not to overcomplicate the process. My responsibility is to recognize the opportunity, execute the trade, and then allow the trend the time it needs to develop. I often meet traders in our user groups who apply this approach in slightly different ways. Some prefer to trade more aggressively and exit positions the moment the signal weakens. For example, they might buy when a stock moves onto a buy signal and then exit quickly when it shifts to a hold signal. That approach keeps them very active in the market and avoids sitting through periods where the price moves sideways. It suits traders who prefer constant action and tighter control over their exposure. My own approach is different. I prefer to capture the full movement of a strong trend. That means I am willing to sit through periods where the stock pauses or consolidates. During those moments, nothing dramatic seems to be happening, and psychologically, that can be uncomfortable. But if the larger structure of the trade remains intact, I allow the position to continue. When the trend resumes and strength returns, I may even add to the position. This idea of adding to a winning trade is one of the hardest psychological adjustments for traders. When a stock rises slightly after entry, many people feel an urge to close the trade and lock in a small profit. There is often a little voice suggesting that the gain might disappear. That internal pressure leads traders to take profits too early. Yet the traders who build significant results are often the ones who allow their winners to grow. My objective is to be larger in the trades that work and smaller in the trades that fail. That sounds simple in theory, but in practice it requires a great deal of emotional discipline. Losses must remain controlled, while successful trades are given room to expand. Over time, this imbalance between small losses and larger gains becomes the engine that drives consistent performance. When I examine strong examples in the market, the structure is usually very clear. A stock is undervalued, its earnings are growing rapidly, and the price begins to move upward with momentum. Once the buy signal appears, the trend can develop surprisingly quickly. Many traders hesitate at the beginning of those moves because the price already feels extended. Yet the strongest stocks often continue rising far longer than most people expect. This brings me back to the central principle behind my method. I want to focus on companies that are creating real financial growth. Earnings expansion is what ultimately drives share prices higher. Technical signals help me identify when that growth is being recognized by the market. But the underlying force remains the company's ability to generate increasing profits. When those elements align, the probability of a sustained move becomes much stronger. The tools I use allow me to scan the entire market for stocks that meet these conditions automatically. Instead of searching manually through thousands of companies, the system filters for the exact characteristics I want. That efficiency removes a great deal of noise from the process. I am no longer guessing where opportunity might be hiding. The candidates appear clearly once the criteria are applied. But even with a strong method, the final challenge remains psychological. Most traders fail not because their strategy is flawed, but because their reactions to wins and losses are inconsistent. When traders experience a winning trade, fear often appears. They worry that the market will suddenly take the profit away, so they close the position too early. Their optimism disappears exactly when patience is required. At the same time, when traders face a losing trade, the opposite emotion appears. Instead of accepting the loss quickly, they become optimistic that the position will recover. They hold the losing trade longer and longer, hoping it will turn around. This reversal of emotional behavior damages performance. Fear appears in winning trades, while hope appears in losing trades, which is exactly the opposite of what a trader actually needs. The solution begins with awareness. When I place a trade, I try to step back mentally and observe my own thoughts as the trade develops. I watch the emotional reactions that appear when price moves in either direction. By recognizing those reactions, I prevent them from controlling my decisions. My responsibility is not to follow emotion, but to follow the rules of my method with calm discipline. The mindset of successful traders is the opposite. When a trade is working, they become optimistic and allow the position to develop. When a trade begins to fail, they immediately become cautious and pessimistic about its potential. That mental shift allows them to close losing trades quickly while giving successful trades the time they need to expand. It sounds simple, but it requires awareness and discipline to practice consistently. The first step is learning to observe your own thoughts while you are in a trade. When a position moves in your favor, pay attention to the internal dialogue that appears. Are you feeling confident about the trend continuing, or are you afraid the profit will disappear? When a position moves against you, notice whether you are accepting the loss or inventing reasons to stay in the trade. That awareness is the beginning of developing a professional trading mindset. Over time, I realized that the real edge in trading is not a secret indicator or a complicated formula. The edge comes from combining a structured method with disciplined psychology. When a strategy produces larger gains on winning trades than losses on losing trades, the mathematics of the system begin to work in your favor. The method simply needs to be executed consistently without emotional interference. For traders who want to develop this mindset, I often recommend studying the psychological side of trading. One of the most valuable books on the subject is Trading in the Zone by Mark Douglas. It explains how professional traders learn to think in probabilities and detach emotionally from individual outcomes. Understanding those principles helps traders remain calm and focused while following their rules. In the end, trading success comes down to a small number of disciplined behaviors repeated over time. Follow a clear method, manage risk carefully, and maintain awareness of your own psychological reactions. When those elements work together, the process becomes surprisingly simple. The market will always remain uncertain, but the trader who controls his mindset and executes his plan consistently places himself firmly among the minority who succeed. Thank you for watching until the end and being part of this journey. Share this video with another trader who is working on discipline and building their mindset in the markets. Write in the comments, "I am in the process." Because becoming a consistent trader does not happen overnight, it is built through discipline, patience, and the process.